Welcome to Explainomics from MarketWatch, where we explain everything around the intersection of business, finance, and everyday life. It's tax season, so today we're going to talk about how to minimize your capital gains taxes. But first, what are capital gains? Why are they even taxed? So let's take a step back and talk about capital assets. That's a stock, a bond, a cryptocurrency like Bitcoin. When you buy a capital asset, your hope is that it will rise in value, and when you sell it, it will be worth more than what you bought it for. So that difference, your profit, that's the capital gain. And Uncle Sam wants a piece of that. That's the capital gains tax. So keep watching and I'll show you how to minimize your capital gains taxes so you can keep more of your hard-earned investment dollars. When we talk about capital gains taxes, the most important factor is time. How much time you held on to this capital asset before you sold it. The key number is 1 year. Anything less than a year is a short-term gain. Anything over a year is a long-term gain. So if you bought a stock, you sold it before a year was over, that's a short-term gain. And you will pay the short-term tax rate. Why is that important? It's because the short-term rate is much higher than the long-term rate. The short-term rate is basically the same as the tax brackets for regular income. You have income at your job or your company, you have your tax bracket, those go up to 37%. That's the tax bracket where your short-term gains will go to. Conversely, if you hold on to your stocks or bonds for more than a year, you'll go into the long-term rate. That's much lower. It only goes up to 20% as opposed to 37%. So you want to be on the long-term side so that you pay less. So what should you do? The first thing to do is avoid trading frequently. Don't keep buying and selling because that's less than a year and it's short-term gains and you'll pay higher taxes. Hold your investments for more than a year, ideally many years. Invest for the long run and your capital gains taxes will stay low. The second thing you can do is invest in specific types of accounts that don't have any capital gains taxes to begin with. The most famous one is the 401k. Most people know that. We have them at our jobs. There's also the IRA, individual retirement account, HSA, health savings account, and the 529 college plans where you save money for future education expenses. All of these accounts are so-called tax advantaged. It means no capital gains taxes whether you buy or sell or hold. So investing in those accounts saves you a lot in taxes. The last thing you could do is use your losses strategically. What do I mean by that? If you buy a stock at $100 and now it's down to $50, those $50 are your capital losses. You can use those losses to offset your gains and hopefully get that net effect to zero so you pay zero taxes. So let's say you made $1,000 in stock A and you lost $1,000 in stock B. Those can cancel each other out. Capital gains, zero taxes. It gets even better. Let's say you lost $2,000 in stock A and you only made $1,000 in stock B. Now you have those extra $1,000 of losses that you cannot offset with your gains. You can still offset them with your regular income from your job, let's say, and then you pay less in taxes for your regular income. You can do that up to $3,000 in losses every year. And if you have more than $3,000, you can roll that over into future years so it doesn't go to waste. So use those losses strategically. By avoiding constant trading, using tax-advantaged accounts, and using losses strategically, you can keep more of those hard-earned investment dollars. For more Explainomics videos and content from MarketWatch, make sure to hit the subscribe button and also keep watching on the Explainomics playlist. See you next time.